Now to our keynote speaker, really, Professor Ross Garnaut. It's absolutely great to have you down in Adelaide. Professorial Research Fellow in Economics at the University of Melbourne. Ross has led many high-level government reviews and commissions. Ross's talk today is on the climate of economics and the economics of climate and how that affects Winegrape demand. Ross is also the chairman of Zen Energy Technologies, based here in South Australia last year. Welcome, Ross.
Thanks, Ticky. Simon, Senator Ruston. I must say it's great to be at Adelaide Oval, and especially great on this occasion. The last time I was here, I grew up in Western Australia and for my sins have remained a West Coast supporter, and I went along to the West Coast game last year where we were thumped by 100 points, and I decided not to come back to the Crows West Coast game this year, and this is a very nice context to be back at Adelaide Oval. I'm going to say something about the global economic situation, bring it back to the Australian situation, and then talk about impact on Australia and climate change in that context. This is a very difficult time for the world economy. The rich countries of the world, the developed countries, with about 1/7 of the world's population, have had their hardest time since modern economic growth began, stretching back to the beginning of this century. We shouldn't really be waiting for a recovery in the developed countries. Things have changed, and we've got to understand how things have changed and adjust to that. Things changed for the worse earlier in other developed countries than in Australia, but it's catching up with Australia now by the measure preferred by the Australian statistician for measuring living standards, net disposable income per person in real terms, adjusted by inflation. We've now had 17 quarters in a row of falling standards of living. That's new and hard for Australia. It's been going on in other developed countries for most of this century. For the early years of the century, that was obscured in some countries. The underlying trends were obscured in some countries by an egregious consumption and housing boom. This was most fierce in the English-speaking countries and Spain, and that all fell apart in the global financial crisis. Since then, we've been grinding along the bottom. We had 1 year of reasonably strong global growth coming out of the global financial crisis in 2010, global average of 4.1%. That's something like the average of the early post-war decades, something like the average of the second half of last century, but that was all the product of stimulus to get the developed world out of the financial crisis. Since then, average global growth has been 2.5% per annum, much lower growth than in the second half of last century. Productivity growth is very low in all of the developed countries. Business investment is very low, so it's a struggle to maintain demand at levels that keep economic growth at optimal levels. The low business investment is one factor behind savings running ahead of investment right through the developed world, which is giving us the lowest real interest rates in history. Three days ago in Frankfurt, the 10-year government bond for Germany went negative. If you lend money to the German government for 10 years, you will have to pay the German government negative interest for the privilege of lending that money. In Australia yesterday, the 10-year bond fell to 2%, the lowest long-term bond rate that Australia's ever seen. This, I think, is not an aberration. These are market interest rates. The 10-year bond is set in markets. It's not the product of Reserve Bank decisions, and it's here to stay. If you've got good investments lined up, then the cost of capital is lower for those investments than it has ever been. That's going to be part of the business environment for some time to come, I would say for the foreseeable future, and only confined to the foreseeable future because we can't foresee beyond that. But the other side of that coin is historically low growth in demand in the developed countries. The whole world is not doing as badly as the developed countries, and I don't have time now to go into the reasons that the developed countries are having this difficulty. Most of the developing world is not doing too badly. The developing world, in terms of impact on global trade and opportunity for industries like ours, Australian wine, is dominated by China. China is still experiencing reasonable growth, much lower than in the first 30 years after 78, the first 30 years of reform, settling down from a long-term average just below 10% to something between 6.5% and 7%. At least that is the Chinese government's aim in adjustment. But it's the adjustment to a slower rate of growth, the adjustment to taking into account the environmental damage that was associated with the old pattern of growth in China, the adjustment to the ending of the labour surplus that drove Chinese growth for 3 decades, and which came to an end. The labour surplus started to run out around 2006, and real wages have been rising very rapidly in China ever since then. So the adjustment to all of these new developments in China, which the Chinese government expects to be reflected in a permanently lower rate of growth, only about 2/3 what it used to be, the adjustment's turning out to be very difficult. I've got a lot of confidence in a good long-term outcome for this adjustment in China, but one has to recognise that the change is very difficult, and there is a substantial risk of big bumps in the road while they're making the change. It's not going very smoothly so far, and there could be more bumps. Well, the role of climate change in all of this, so far, not so very big. Climate change is a huge challenge for long-term economic growth. It's just starting to have its effect on global growth now. The climate science tells us that the destabilization of North Africa, Syria, Lebanon, from about 2007 was associated with drought events that can't be explained without reference to climate change, and the destabilization of North Africa and the Middle East is part of the story of slower growth in Europe, but not yet a dominant part of the story. One can expect that the increasing warming of the climate and the change in rainfall patterns with which that will be associated to provide periodic headwinds and shock to growth that gets bigger over time. But so far, that's not a dominant part of the story of the slowdown of growth in the developed countries and the world as a whole. The climate story is an insidious long-term one in its effects, and it is going to fundamentally change the context of much of our business. Certainly it will change the context of Australian agriculture. The climate science tells us to expect that without mitigation, without major efforts to change the relationship between economic growth and greenhouse gas emissions, that through the course of this century we would end up with temperature increases about 4 degrees or more Celsius higher than they had been in the history of the world up until the last couple of decades. Already we've had on average around the world about 1 degree Celsius increase in temperature, and that takes us up to the very top of the range experienced by humans since the beginnings of human civilization. It's inevitable that no matter how strong and effective the global effort to reduce greenhouse gases, that the momentum in the system will take temperature increases to at least another half degree increase beyond what we have now. But that would be a very ambitious outcome, to hold temperature increases to 1.5 degrees. It's an objective of the international meeting that most world leaders attended in Paris in December, to reduce greenhouse gas emissions enough to hold temperature increases to 1.5 degrees. But that would really require decarbonisation, removal of carbon from our energy systems, from our agriculture, from our transport over the next decade or so, and in the best of circumstances that's going to be very difficult. The second stopping place is the backstop objective of holding temperature increases to 2 degrees. That's not easy either. It was given a lot of focus at the Paris meeting. The leaders of the world committed themselves to that goal, but that's going to require the complete decarbonisation of energy by the middle of the century, only 34 years away. And so it can't be taken for granted that we will hold temperature increases to 2 degrees. So how does an industry like Australian wine growing adjust to that? I think the first thing that's necessary is to take the reality seriously, understand as best you can from the available science, and there's a lot of it in Australia, very good work from the CSIRO and many of our university science departments on the likely impact of temperature increases. The climate models that allow us to turn general stories into assessments of likely impacts in particular regions are getting better all the time, but they're still highly imperfect. We need a lot more investment in the applied science as a background to guiding our adjustments, but I think it's very important to understand what can be understood from the science that's already been done. The general story across southern Australia, where most of our wine grapes are grown, is apart from the warming, which of course disproportionately increases evaporation and disproportionately reduces stream flow and runoff into the rivers, so it disproportionately reduces water available for agriculture. But there will also be changes. There are also already changes in patterns of rainfall. The general story that I get from the science of rainfall change in the sorts of latitudes where most Australian wine is grown, the Mediterranean latitudes, is that the wind systems that bring rain, especially the winter rain, will tend to shift towards the poles, so that regions like the Mediterranean in Europe and West Asia, North Africa, the latitudes of Central California, Sacramento Valley, the latitudes of Chile, central Chile around Sacramento, latitudes of Perth, Adelaide, the latitudes of South Africa, just north of Cape Town, will all see substantial drying. We need to understand that. The science can tell us a fair bit about that. If we're going to adapt to this very substantial change, we have to squeeze everything we can out of the scientific knowledge that it's available about what is likely to happen. I think the second general lesson is that we should all be on the side of strong mitigation, because it's going to make a lot of difference whether the temperature increase is going to be 1.5 or 2 or 3 or 4 degrees. So Australian agriculture needs to be barracking hard for strong mitigation. And thirdly, the mitigation effort is going to involve quite rapid changes in our energy system under the policies that, and especially under the objectives that the Australian government accepted at Paris. So we were part of the Paris Agreement, made certain commitments there. We committed ourselves to reduce emissions by 26 to 28% from 2005 levels by 2030. But not only that, we agreed to be part of an international process that would keep ratcheting up, tightening those objectives until the world had got itself onto a path of getting holding temperature increases lower than 2 degrees. So we're part of that process of ratcheting up the mitigation effort, with the first big international meeting to turn that general objective into a revision of our targets in 2018, and we've committed ourselves to be part of that. The big change in energy systems is potentially a source of higher costs. Mercifully, changes in technology, reductions in the cost of zero emissions energy and the storage of zero emissions energy are reducing the costs of taking the carbon out of our climate systems. And given the very large increases in the price of traditional forms of electricity in recent times, going up again in South Australia by 6 to 12% on July the 1st, it's now becoming economic to be part of the mitigation process, the emissions reduction process, and to actually lower energy bills. The costs of alternative forms of revenue for many users are coming down, are highly competitive, and really it's in recognition of the role that using these new technologies can play in Australia's mitigation effort that I accepted the chair of Zen Energy Technologies based in Adelaide in October last year. I've got a couple of my colleagues from Zen here who can talk to you at morning tea about that. Now, finally, on Australia's adjustment to these difficult international economic developments. I published a book called Dog Days, Australia After the Boom in 2013, in which I traced out some of the implications of the international developments that were facing Australia. Regrettably, that the prophecies of that work have been gradually revealed in what's happening in Australia. The central part of the special challenge facing Australia in 2013, and still with us today, we haven't made much progress yet on some of the fundamental issues, is that during the resources boom, the cost structure of Australia, what economists call the real exchange rate, our costs compared with other countries when you convert costs into the same currency, have risen extraordinarily. During the resources boom, roughly from 2003, the peak of the boom was 2011. It's been coming down since then, although the exchange rate held up for quite a while. At its peak, there was an appreciation of 70% in the Australian real exchange rate. Our exchange rate, compared with other countries, when you adjust for differences in inflation, well, that was a unique loss of competitiveness amongst developed countries. I can't quickly see in the international record a comparable decline in competitiveness as the 70% appreciation of the Australian real exchange rate between 2003 and 2011, 12, 13. It's beyond the experience of developed countries. That had huge effects. And when I was listening to Simon talk about the disappointment in exports, we do have to recognise that this is part of a more general Australian story of disappointment in exports outside the resource industries since the beginning of the resources boom in 2003. In Dog Days, I presented a number of charts on what has happened to the real value of Australian exports other than resources during what I call the reform era in Australia, when we were improving our competitiveness from 1983 until about 2000, and since then. And I've got a chart in Dog Days about what happened to wine exports. And back at the beginning of Australia's reform era in 1983, we used to import about the same value of alcoholic beverages as we exported. We drank about as much French champagne and Scotch whisky as we exported in wine. Over the next 20 years, we saw a huge expansion of net exports, so that by 2003, which is really the high point of Australia's export performance outside resources, the net exports of wine were about $5 billion per annum. Well, that was a very big story. $5 billion adjusted to today's prices. I presented the numbers in real terms. And then the real exchange rate, Australian costs in international currencies relative to other countries, started to go up, and we lost that 70% in competitiveness. And by the time I took out the data for the book in 2013, we were back to where we were in 1983. We were drinking as much imported grog as we were exporting, and that huge period of productive, profitable expansion of Australian alcoholic beverages had ended. Well, you can tell lots of stories about that. There's lots of marketing things we could have done better, lots of protection of our brand we might have done better. But the central story is one of the general loss of competitiveness of Australian non-resource exports as a result of the appreciation of the real exchange rate. And why I'm confident in making that judgment, that it's part of the general story, is that something very similar happened in just about every non-resource industry that was making good headway in exports from 83 till 2003. Take tourism. Back in 1983, Australians were going abroad in twice the numbers as foreigners were coming here for tourist purposes. By 2003, with the internationalisation of the Australian economy, Australians getting better at presenting themselves in international markets, we had twice as many tourists coming here as were going abroad. And then, same story as with wine, by 2013 it had reversed and we were back to 1983. And you get a very similar picture in sophisticated manufacturers, in business services. It's a general phenomenon. Now, in the book, Dog Days, Australia After the Boom, I said the central adjustment that Australia had to make to get out of the dog days was that we had to have a general and large improvement of competitiveness. We had to get down the real exchange rate again. It had gone up so far. Obviously, the very high export incomes from resources had been the driver, but the exchange rate went up much further than it needed to, because we basically spent the revenue from the resources boom as it came in, increased domestic demand, and that put up the real exchange rate. Very different strategy to Norway, which put most of the increase in revenue from higher oil prices into a sovereign wealth fund and didn't spend it, and so it didn't have the same appreciation of the real exchange rate, didn't lose competitiveness in the same way. So I said in 1983 that in 2013 that our nominal exchange rate had to come down. Our real exchange rate had to come down at least 20 to 40%. At the time, the Australian dollar was worth 1.05 US dollars, and the consensus of business economists was that the dollar was heading to $1.10 or $1.20. I said it had to come down 20 to 40. Well, it's come down into that range against the US dollar, but just looking at the Australian exchange rate against the US dollar misses a lot of the story. Our inflation rate has continued to be much higher than in other countries, despite the fact that it's relatively low, because you've had zero inflation in the last 7 or 8 years in most of Europe, in Japan, in the United States, recently in China. And also the United States dollar has appreciated a lot against other countries which export agricultural products. So the US dollar has appreciated enormously against the currencies of Brazil, of Argentina, of South Africa. The real exchange rate should be measured against an average of other currencies, and we haven't come down anywhere near as much as it looks as if we have, if you just look at the United States dollar. We need further improvements in competitiveness, further large reductions of the real exchange rate if we're going to maintain growth and restore incomes in Australia after the very difficult period we've been through. Why has the real exchange rate held up so far? Well, it's not increases in Australian costs anymore. Australian wages have been growing less rapidly than they ever have since records have been kept. There are a few industries like electricity where monopolistic arrangements and poor regulation is leading to continued increases in prices, but on the whole they are exceptions at the moment. The reason our competitiveness hasn't improved as much as it needs to is that our short-term interest rates, which govern short-term capital flows, remain well above the rest of the developed world. 1.75% cash rates seem very low, but they're not low if your cash rate is negative, as it is in continental Europe or Japan. You still send money to Australia for yield. If you're in those countries, it's not low. If you're in the United States, where cash rates are about 0.5%. I think that our monetary policy has been behind the game in adjusting to the new global circumstances of diminished demand, of excess savings, our keeping interest rates low, historically low, but well above those of the rest of the developed world, is a major impediment to the restoration of competitiveness. And I think we've got to catch up with the game in monetary policy before we can catch up with the game in competitiveness. and before we're in a position competitively to take full advantage of all of the advantages to which Senator Ruston, the very real advantages that are available through, for example, the free trade agreement with China. Thank you.